There's some important topics that all of you are seeing in the news right now that we've got to talk about. One being tariffs and the other being the weakening of the US dollar. Very important that all of us are aware of what is happening and what this means for our money. I'm Dean Lolkin, investing veteran, private credit CEO, here to help you grow your wealth. So the dollar index is now at 104. It's come down from 109, 110 just a month or two ago. And we're talking about tariffs. And so what we're seeing is an enormous rally in non-US stocks. There's a dramatic difference year to date in the performance of US and non-US stocks. For the most part, US stocks are roughly flat. We've got the equal weighted S&P 500 up a tiny. The Russell 2000 down about 5%. The S&P 500 almost flat, while the MSCI EFA index is up about 11% or over 11% year to date. That's a big spread. Now, foreign stocks haven't outperformed the US in more than a decade. That is a dramatic difference that we're starting to see develop. And part of that can be attributed to the weakening of the US dollar. Obviously, when our dollar weakens, foreign currencies appreciate. And so when you invest in foreign stocks, your investment returns increase by the amount that the currency appreciated against the US dollar. So Japan is rising, Europe is rising. We don't see that so much with tariff-threatened countries like Mexico and Canada, but the European and Japanese economies are much, much bigger. We're seeing some outperformance in emerging market stocks as well, because the emerging markets index, which is represented by an ETF, ticker EEM, is also rallying up about 5 or 6% so far this year. Not as well as the ticker EFA, which is the iShares MSCI EFA, but still doing really well relative to domestic stocks. So everyone wants to know, is this going to continue? Of course, we want to know that. And should we rotate? Should we make drastic portfolio moves? What are your portfolio managers saying? What are your investment advisors saying? I'm super curious. Please put that in the comments. But we know that today the MSCI World Index is made up about 75% of the US and 25% of developed markets. So the US is very, very dominant after so many years of outperformance. But if you have no exposure to foreign stocks at all, not emerging markets or developed markets, you're missing out. So should we sell all our US stocks and allocate completely to Europe, Japan, Australasia, the Far East? Absolutely not, right? That's the dumbest, craziest thing we could possibly do. But should we start taking some steps and moving in the right direction of diversification, making sure that our portfolios are aligned a little bit more globally than they have been in the last decade or two? I think that that is a fair question to consider and one worth pondering and one worth discussing with your financial advisors. Because if you don't have 5, 10, 15% today allocated to foreign markets, you're probably missing out. Now, what other assets have done really well in this weaker dollar environment? Well, gold. Gold has done extremely well and has outperformed even cryptocurrencies so far this year. Gold has done about as well as developed markets foreign stocks, about 11% so far. And it did really well last year as well. So gold and foreign market exposure are probably important components of your portfolio that if you've been neglecting them completely, you want to reconsider. And there are some less drastic ways that we can start to inch into some of these assets without converting our entire portfolio into a foreign and gold only play. So should we give up on our US exposure? I think we already said absolutely not. But what do we think the future holds in 2025? Well, if we use pre-COVID as an example, we think about the years 2015 to 2020, that 5 years before COVID, the dollar was much, much weaker than it is today. And what happened then? Did foreign companies outperform domestic? Did gold do well? And the answer to both those questions is absolutely not. So what is it that we're hoping for as the dollar comes down further, and who will it benefit? So we believe that it might benefit foreign stocks, but our experience prior to 2020 puts that into question. And what companies benefit the most from this dollar depreciation? Well, I think you'll be surprised to know. Now, do we think small company stocks, like represented by the Russell 2000 index, or even the mid-cap 400, do you think they'll benefit from a falling dollar? Well, smaller companies are very US centric. They just don't have the kind of customer and revenue exposure that larger companies, multinationals, do. And where are the multinationals? Well, most of them are in the S&P 500. And a lot of us are already very exposed to the S&P 500 using ETFs, whether it's Vanguard or things like iShares. So, which part of the S&P 500 is going to benefit the most from these currency trends? Well, now you'd think that it might be industrial companies, manufacturers, even consumer products plays. But the real beneficiaries of currency fluctuations are technology companies, the ones you already have enormous exposure to within the S&P 500, as we always discuss, right? The Magnificent Seven gives you something like 30% of the S&P 500 or more. So why is that? Well, tech stocks don't require factories to manufacture their products. So when they sell a product in Europe, in Asia, they're benefiting from that currency exchange rate that's benefiting from the weakening dollar. And so as you see this happening, it is going to provide additional benefits during those earnings calls from the likes of Microsoft, from the likes of Meta, from the likes of Google, Nvidia, Tesla, etc. Now, Tesla is a little bit of a unique play, but suffice it to say, the tech companies will benefit the most. Now, do they hedge currencies to limit some of this upside? Some of them do. Microsoft does to some degree, but not as much as an auto manufacturer that is hedging currency by doing what? By putting their manufacturing plant in the country where it's going to sell those cars. Now, Europe does that a lot more than the United States. So for them, a weakening euro doesn't benefit their manufacturers quite as much as it benefits our giant tech sector. So counterintuitive play here, but you're already exposed to this weakening dollar theory, this weakening dollar trend, simply by having a lot of exposure to US tech. They are going to benefit the most when it comes to the next earnings call. As we look at 2025 and we think about how should we be exposed throughout our portfolio and what changes we should be making during these turbulent times, we got to remind ourselves that the S&P 500 index is still not in correction territory. Now, we're not too far off from a 10% correction, but we're not that close either, right? 6 or 7% lower from a peak isn't even near that 10% correction level. Now, tech stocks probably have reached the correction at this point, but the S&P 500 just isn't even there. And the reason that we earn outsized returns in our stock portfolios is because of volatility. If there was no volatility, these returns wouldn't be possible. And so we have to be able to stomach the ups and downs that come with that. And do these corrections come that often? Well, we haven't seen a correction like this, or down 10%, in over 18 months. That's not very often, right? The last time we saw a bear market down 20% was 2022. So we're already 2 to 3 years out from something as gut-wrenching as a bear market. And so as investors, we have to be able to tolerate these kinds of fluctuations in returns if we want to earn 10%, 11%, 12% or more annually to be able to grow our wealth. Otherwise, we stick our head in the sand and put our money into a money market fund earning around 4% today. Maybe a CD pays a little bit more if you can lock your funds up for a year or two. Now, there are some alternatives, right? Certainly private credit, including lending to home flippers and other small businesses, offers some higher yields with higher associated risk. But as far as large liquid investments go, short-term treasuries and money markets are paying about 4% today. And we see that the yields on the long-term treasuries are starting to come down. Now, they've come down into a range that they've been in for about a year or two. What do we think? Do we think they're going to pierce that range and start going into the threes, right? Below 4%? Now, that's possible. And it's possible the Trump administration and Scott Bessent, Treasury Secretary, will continue to talk rates down. But there's a lot of resistance there in the marketplace to rates falling that far. There are inflation expectations that are keeping long rates higher. And until inflation expectations completely diminish into that 2% range from roughly 3 to 4%, we're probably not going to see long rates in the threes. Now, are there some ways the current administration could force long rates down. Yes, absolutely. They have a lot of fiscal and monetary tools at their disposal. I do not think that that's likely. And so what I think is most likely is that long rates will continue to be in this 4 to 5% range throughout 2025. And I don't see the Federal Reserve moving short rates down all that much more, maybe one rate cut or something like that. But it's not going to yield a tremendous benefit to folks that are looking to take on a mortgage, finance a car, or companies that are looking for relief on their debt load. We saw a huge amount of Twitter and social media activity the last few days, talking about how the administration is trying to crash the economy essentially in order to refinance trillions of dollars of debt, of government debt that are coming due this year. Now, all of that in order to save a few tens of billions of dollars on their interest payments for this particular set of treasuries coming due. Now, if that doesn't sound insane, right, you should get your head checked, because that is not the kind of trade-off that the pretty intelligent people that are running our Treasury Department or the Federal Reserve or anywhere within the government, they're not going to tolerate this type of trade-off. So now they might tolerate talking about this kind of trade-off, but it is not something that they're actually looking to affect, because their constituents, the folks that voted them into office, will boot them right out of there at the next midterms if the economy truly crashes the way that these social media headlines believe it could, just simply given the recent moves in the Treasury yield and the lower growth expectations that have come from talking about tariffs, talking about protectionism, and talking about kind of an America first aggressive foreign policy. So I remain very, very optimistic about the rest of 2025. I think that this is very normal volatility that all of us have to live with in order to earn the higher returns that are available to us in the stock market. I think the US remains the number one asset in the world. I'm all for bigness. I am still bearish on smallness. So I believe that our money is best served by being in the largest companies, at least for 2025. And I do think that investors with 7 figures in investable assets and liquid assets should be looking to add both foreign market and precious metals exposure if they are not comfortable with small Bitcoin and Ethereum exposure to replace some of that store of value and alternative asset exposure in their portfolio that would normally go to gold. So again, I think that portfolios should remain fully allocated. And if you do have some money market and cash exposure, the next few weeks and now, these are great times to be buying assets on sale, buying your favorite ETFs and getting more fully invested. Now, how do we know that you might not be fully invested? We know that because the AAII, the American Association of Individual Investors, the sentiment readings are tremendously bearish. And if you're Warren Buffett, if you're a savvy investor, and Warren Buffett always said, they said, how did you know you were going to be rich, Warren? His answer was simple. Well, I went to Vegas and I saw intelligent people dressed nicely playing games that were designed for them to lose. And that's when I knew. So let's not be the nicely dressed, intelligent people playing in the casino. Let's be Warren Buffett taking their chips from them. So how do we do that? That means that we don't have FOMO when we see the top. When we see things at a discount, that's when we buy, when blood is in the streets. Now, there's no blood in the streets today, but there's certainly very, very dour sentiment, and that is a great opportunity to deploy excess cash. And so this is the time to think through, where is my cash located? Do I have some bank accounts sitting around with a few extra tens of thousands of dollars that might be earning 1 or 2%? Check my brokerage account and make sure that I haven't been making contributions into cash the last few months. Have I sold some assets, maybe in anticipation of a volatile election, and haven't redeployed them? Deploy them now. So, and again, I don't mean now by today, this minute. I mean that make a plan to deploy your excess liquidity over the next week, over the next month, over the next 2 months. Create a plan and do it according to the plan so that you don't rely on your emotions, because generally your emotions will mislead you, right? When you see a down day, as opposed to your brain, your caveman brain thinking, well, this is on sale, I should go shopping, the brain takes you in a completely wrong direction, right? It brings you to fear. Why do we always always go to fear? We always talk about loss aversion. The reason it goes to fear is because we hate losing 2.5 times more than we like winning. And so it's a much more powerful instinct to avoid further losses than to think about any potential gain. That just does not affect us as much. And so that's why when we see green on our screens and we see green on CNBC, we see green in our portfolios, we're much more likely to buy. And red scares us away. And it should be the opposite, right? You do not act like this at Nordstrom. You don't act like this at the grocery store. It doesn't make a lot of logical sense, but we have caveman brains. And so that's why it's important to watch content like this to remind ourselves that we have to often do the exact opposite of what our instincts are telling us to do. That's why we struggle getting good help, right? What do we do when we're looking for investment advisory help? And I'll give you guys a real example of a friend of mine who is relatively well off. And I once asked her, I said, how did you pick this gentleman to be your financial advisor? She said, well, he's got really cute kids. Really cute kids. That's how you make decisions about who to hire, right? He's a handsome young man with a beautiful family. Now, what does that tell us about his ability to help us invest our assets? Absolutely nothing. What it tells us is the investment management business is a sales and marketing machine. And a sales and marketing machine depends on vanity and, to some degree of chicanery and I wouldn't call it fraud, but certainly some degree of salespeople misleading prospects or customers into having more confidence in them than they should. And so as we look at our own service providers, we have to ask ourselves, who are these folks and why did I pick them to begin with? Do I understand their track record? Do they provide me regular updates on how they do relative to benchmarks? If they're just salespeople and they don't manage my assets themselves, they purchase funds or select managers for me, am I getting the right data and the right information on how all of these selections are working together? And what am I getting in return? And more importantly, what kind of fees am I paying? Am I paying appropriate fees for the service and the returns that I'm receiving? For the most part, today, the answer is no. Unless you are a index fund boglehead that's fully invested in Vanguard, if you're with one of these large brokerage houses, you're being sold products that are suitable for you. Even if you're with a fiduciary, a registered investment advisor, look in your portfolio. How many stocks do you see? How many funds do you see? Do you see dozens of funds? Do you see hundreds of stocks? That over-diversification means you're paying enormous prices for glorified index funds. All right? When you have hundreds of holdings, there's absolutely no way that investment manager, in their heart of hearts, is expecting to outperform the benchmark, right? And so what they're doing is really selling you something. And even a fiduciary, even though they have your best interests in mind, doesn't mean they're good at their jobs. One simple rule I have about fiduciaries is they say that they're doing things in your best interests. Ask them a simple question. How big is your marketing department? And how big is your sales department? Give me the head count. And then tell me how big your research team is. How many folks work on your trading desk? How many folks manage my portfolio and the portfolios of your clients? If you see a big mismatch there in headcount between sales and marketing versus research, investments, and trading, you've probably got your answer. And so that can be okay if you're paying very low or reasonable fees. But if you're paying 1% or more per year for that type of service, and we're not talking about flat fees, we're talking about a percentage of your assets, this might be a problematic scenario for someone with $500,000 to $5 million in liquid assets. Now, folks that are starting to get closer to that 8-figure range might need some specialized attention and service just relative to the size of their assets. They might need some more diversification into some more alternative, more complex and esoteric strategies, because that size of portfolio might benefit more from that level of diversification. But when most of us who are doing well in the United States today are working with $500,000 to $5 million in liquid assets outside of our primary residence, we just don't need this level of complication. What we do need is a level of scrutiny on the people who are working for us, managing our money. And today, I can't even think of any organization, any third party that's there to help investors double check what these folks are doing on their behalf, right? There is no second opinion, if you will, if you take a little page from the medical field, right? None of you are taking your portfolios, what your asset managers are doing, and you're not taking it for a second opinion to an expert. And I'm not talking about a competitor, because that's not a real second opinion. I'm talking about a third party that is unbiased, that is there to solely provide that service for you, to assess the performance and give you an honest feedback about what your investment professionals are doing relative to what they're charging. So it's something I'm very interested in developing further as I think about more businesses that I'd like to build. But definitely food for thought. Think about, how do you evaluate the folks that are currently helping you? And if you were to get a second opinion about what they're doing for you, where would you go? So 2025 is unraveling, and there's a lot to be excited about. There's a lot of fear in the market. There are lots of assets doing interesting things they have not done in a long time. And make sure your portfolios are positioned accordingly. I'm Dean Lolkin. Thank you for watching, and please subscribe to the Dean's List.